Welcome to Efficient Tax's video on managing expectations. In this video, you're going to learn about 4 important attributes to proper price targeting and expectations management. These are understanding the importance of reasonable price targeting, price-based price targeting, earnings-based price targeting, and managing, saving, and using stock expectations. These attributes will help to ensure that our customers achieve the highest quality sell decision and portfolio optimization results. These can only come about through the use of reasonable price and stock performance forecasts. By the time this video is over, you will understand the importance of expectation management and how to use the powerful price targeting tools within EfficientTax.com. So, let's get started. In order to maximize after-tax wealth, one has to step into the after-tax world, and in order to do that, one needs not only cost basis but sell price as well, so that the after-tax impacts can be calculated for decision-making. Nobody knows for sure what a stock's price will do over time, but reasonable forecasts can be made. An electric utility is more likely than not to grow its annual earnings in the 2 to 5% range. A successful and mature consumer products company might reasonably grow its earnings between 6 and 12% most of the time. A more refined analysis of earnings history of each company can narrow that range. If one were to assume an aggressive earnings growth rate for a current holding and a modest reinvestment rate of return, and a sale can still be justified due to a current price and valuation, then it would likely be less risky and more advantageous to sell rather than to hold. If any reasonable variation of an expectation set indicates a sale, then a sale and reinvestment is fully warranted. In the end, deciding when to sell a taxable security and understanding the metrics of how a company must perform in terms of earnings and price in order to justify holding on to it, coupled with an assessment of how likely that is to occur, is better and less risky than not knowing. It is better to know rather than speculate how much extra return is required from an alternative investment in order to recover the tax cost of selling a taxable security, recognizing that things like cost basis and tax rates make a big difference. Bigger tax bills resulting from lower cost basis or higher tax rates require greater amounts of extra returns in order to recoup the tax costs of selling. Therefore, different tax lots have different prices in which a sale or a continued hold can be justified. Good forecasting takes the guesswork out of knowing when it is time to sell a taxable security. Fortunately, in order to help subscribers, we have incorporated powerful stock price forecasting tools in our website, including 3 to 5 year stock price forecasts from America's most respected independent and third-party equity research institution, ValueLine. EfficientTax.com provides investors with 2 methods of price targeting over a 3, 4, or 5-year investment horizon, either price-based or earnings-based. Let's start with price-based price targeting. Investment horizons of less than 3 years require higher and less certain reinvestment rates of return in order to recover and profit from a capital redeployment tax cost. Price forecasts beyond 5 years represent another form of greater uncertainty as well. That is why we incorporate 3, 4, and 5-year investment horizons in our analysis. An investor can have greater confidence in a decision to sell if a recommendation to sell is indicated regardless of time horizon chosen. Also, the higher excess returns forecasted resulting from a sale and reinvestment as a result of using price forecasts the user feels are reasonable, the more compelling a sale decision. The most basic form of price targeting is to pick a future price that one believes a stock will achieve during a market cycle of the next 3 to 5 years. Our price-based price targeting facility supports that method by keeping a chosen price target constant at the end of a 3, 4, or 5-year horizon. It allows an investor to forecast what price level a stock is likely to achieve without having to know how long it will take to get there. Users may choose to save and use their own price-based price targets for stocks in a portfolio, or they may use 3 to 5 year price targets provided by Value Line, America's most prestigious independent equity research institution, where we take their forecasted 3 to 5 year low and high price targets, add them up, and divide by 2. This is available through the purchase of our institutional price targeting research. Now, let's take a look at earnings-based price targeting. The earnings-based price forecasting method, a fundamental bottoms-up forecasting approach, has more moving parts than a price-based approach. It requires an assessment of how much in earnings a company is able to make on a sustainable basis, how fast it will grow its earnings, and how much the market will pay for those earnings in the form of a price-earnings multiple. The earnings-based price targeting method, more rigorous than a price-based method, allows investors to get a price target on a calculated incremental basis that allows investors to test the reasonableness of price forecasts on a fundamental basis. Users may choose to save and use their own earnings-based price targeting inputs, or they may use those provided by Dynamic Capital Management. Dynamic Capital Management is a registered investment advisor that specializes in doing detailed quantitative research on more than 600 of the largest publicly traded companies, including most members of the S&P 500 and the NASDAQ 100. It is also the parent company of Efficient Tax, LLC. Our final section is about managing, saving, and using stock expectations. The biggest risk factor in an efficient tax portfolio analysis is the degree to which stock price forecast and a reinvestment rate of return assumption are materially wrong. Everything else is just mathematics. Therefore, it is incumbent upon a user of Efficient Tax to take the time to review the performance expectation sets for each company owned in a portfolio under review. This is in order to make sure that they're reasonable. In addition to the capital return potential of a stock by comparing its current market price compared to a future price target, dividends can be another important contributor to before and after tax returns. Therefore, the dividend amount and growth rate are additional expectation inputs that should be properly managed and maintained. For your convenience, we pre-populate into dividend input cells current publicly traded stock dividend amounts available from bar charts, but we don't automatically attach a dividend growth rate. Dynamic Capital Management does detailed analysis of dividend payment histories on all the companies upon which it does research, including that of a board of directors' dividend policies by tracking dividend amounts, dividend growth rates, and dividend payout ratios over a 10-year period. Oftentimes, a company determines its dividend distribution amount is not sustainable, and it reduces its dividend payout levels. In its forecast, Dynamic Capital Management will artificially lower to a more sustainable level a company's dividend amount to 75% of recent earnings, if its distributions exceed those earnings and it has a weak balance sheet. This is to lower the risk that a dividend amount forecasted will be too aggressive. Dynamic Capital Management's refined, sustainable dividend amounts and research-based dividend growth rate assumptions are available to users with the purchase of our institutional price targeting research, along with its earnings, earnings growth rate, and PE assumptions. The last input that may be saved at the company level is a risk premium adjustment value. It takes into account differences in risk profiles between individual stocks and a reinvestment return assumption. Please review the tooltip for this item by hovering your cursor over its label on the input page, or read more about it in our Inputs Explained document located in the Education Library. In the end, a complete expectation set for each company might include a price target, an earnings base, an earnings growth rate, a PE assumption, a dividend amount, a dividend growth rate, and a risk premium adjustment. A user may save any of these inputs as a user expectation either within the Expectations tab or within the primary input page. Within the Expectations tab, a user may click the boxes of any individual stocks they wish to review and update expectations for, and then click the Edit Selected Expectations button, after which all selected stocks will be displayed with their current expectation sets visible and accessible for modification. From here, investors may click to show DCM and value line price and other targeting information either individually or all together if subscribed to. They may select a company for updating by clicking the box on the left-hand side, and they may save selected user expectations. We also provide a price targeting assist tool at the individual stock level. It assists investors in accomplishing fundamental price targeting reasonability testing. If a price target of $50 is chosen, and it takes an unreasonably high earnings growth rate to achieve, this tool will help identify that. As a starting point for price forecasting, we pre-populate into the Price Targeting Assist tool any company's earnings base, growth rate, and PE provided by the user, and from Dynamic Capital Management, if that is available and subscribed to. And finally, a user may save selected expectations right from the main input screen. These may be individually inputted, or if either value line or DCM expectations are already pre-populated into the input cells as defaults, they may be saved as user expectations right from that screen by clicking the Save as User Expectations button located below the Selected Positions in Analysis section. Well, there you have it. In this video, you've learned about the 4 important attributes to proper price targeting and expectations management. These are importance of reasonable price targeting, price-based price targeting, earnings-based price targeting, and managing, saving, and using stock expectations. Thanks again for watching this efficient tax instructional video on expectations management, and good luck in the markets.